So welcome everyone to the crypto conversation at CDFT Columbia. This is part of a series that we have initiated together with Fahad Saleh, who is a professor at the University of Florida and an advisor at the Columbia Center for Digital Finance Technologies. And today we have the pleasure of having with us Jessica Wachter. And Jessica is the Bruce Jablos Professor in Quantitative Finance at the Wharton School at the University of Pennsylvania. I think we are very pleased to have you today with us, Jessica, and we'd like to discuss and brainstorm on topics related to crypto regulations and crypto economics. And we'd like to start taking advantage of the fact that you served as the SEC Chief Economist during the Biden administration. So we are curious and we want to learn more about how that experience was. What does Chief Economist actually do? And is there any economic analysis that is used to inform decision-making at the SEC?
Well, first of all, thanks so much for inviting me. I'm very happy to be here. Right, so I was Chief Economist from May 2021 to January 2025. And the Chief Economist does a couple of things. So first of all, Chief Economist runs the Division of Economic and Risk Analysis. So that's one of the divisions at the SEC. And the second is to serve as an economic advisor, as the name suggests, to the chair and to the other commissioners. Now, economics are very important at the SEC. Economic analysis is very important, and it takes several forms. When I was there, we were involved in the whole life cycle of the rules from the planning stages often through even the implementation stages.
Yeah, good. And continuing on this line, we as academics read a lot of papers about like impact of crypto innovations like exchange, centralized or decentralized, and we wanted to know like whether or not academic research make its way into the deliberations that are actually eventually done at the SEC or at similar governmental institutions. So basically, just to be more concrete, when the economists at the SEC, the one working, for example, in the division for risk analysis that you are mentioning, are evaluating a new proposed rule, do they draw on existing study from the academic community, or do you think there is still a gap between what academics are researching on and what instead is needed to evaluate a good proposal?
Well, I think that the staff would always like to see more economic work done on SEC proposals. That said, the staff pay very careful attention to what outside economists are working on. So it absolutely makes its way in. And it's one of the ways that economists can really influence policy is by being aware of what the SEC is doing and writing relevant papers. So this is one of the really nice features of having economists so deeply involved at the SEC. Economists are going to naturally be following the literature. So I would say that absolutely that research finds its way in. Now, you gave the example of crypto. So crypto has already, changed a lot since even 2025. And so you have to keep in mind through the period that I was there, this nascent field was growing. So my experience was often with research that was done on equity market structure and treasury market structure, and that's still very important. And of course, as maybe we'll get into, there wasn't a lot of crypto rulemaking, but certainly I'm pretty confident the staff would be looking at crypto research.
So if I can ask a follow-up question there, in terms of the academic literature playing a role in the SEC's analysis, could you give a concrete example from your time at the SEC, whether it's crypto related or not, just to sort of understand the way in which academic work does get factored in?
Yes. So one example that comes to mind is I'll bring up the Treasury clearing rule. So that's a important rulemaking that's establishing clearing for Treasury securities, repo securities, and this was something that there was attention from in the academic community showing, and there was work showing how Treasury clearing would have reduced, costs and risks. And so that work was cited in the release, used as a way of establishing that this would have economic benefits. So that's one example. Another example, building on that same example, is this idea that clearing of swaps, Title VII after the financial crisis, bringing swaps into clearing made that market structure better. So there was a published study following that implementation. And so that was specifically cited as well. Another case is, so we worked on, now ultimately this rule is at the moment, I think in a bit of a limbo, but we worked on a securities lending tape. And so there, the prior work on trace and corporate bonds and how the transparency around post-trade prices, how that actually made spreads fall following the implementation of trace was pretty relevant to how you think about what might happen, what I still might hope might happen someday if there's ever a tape that's like trace that talks about securities lending prices. So those are just a few examples that come to mind. I'm sure there are more.
So is it fair then to say that this is sort of when the SEC is putting some rules in place, they're looking for sort of, let's call it qualitative evidence that the rules could actually be beneficial? Because I guess there's also sort of let's say a more econometric, empirical, quantitative potential dimension. And I'm just trying to understand from your response, it sounded, and I may be misinterpreting, so please do clarify if I've misunderstood. Should I think of it more as academic research can sort of highlight qualitative ways in which, for instance, certain things the SEC can do can be, welfare enhancing, or is it more of a quantitative exercise?
Right. So, well, I'm going to take your question in a certain direction, and you can tell me if this is what you had in mind, because, as economists, we do lots of different kinds of work. For example, one of the things that has taken off recently, meaning the last decade in economics, is more structural analysis, counterfactual policy experiments. And while that's got the word policy in it, I would say at the time of present speaking, in some sense, it's the work that's just the more basic econometric. Is there an effect here? Is it identified? Is probably more influential. And that's because there's just a lot of things we don't know about any situation. And so it's the first order question is, what do you expect this rule to accomplish? What's the market failure that it's addressing? So, for example, if you can't really name one, you have to ask yourself a question about whether, why the standard Hayekian results about markets delivering the best outcome doesn't hold. So what's the market failure? That's often not, in principle, that hard to figure out in the case of a transparency rulemaking, for example, because nobody has the right incentives to create exactly what you'd want to see in a required transparency regime, just as an example. So my point is that you want to see some idea of what's the problem, why do we think that this action by the SEC is going to solve the problem, more than a precise quantitative estimate.
Okay. And if I can ask one more follow-up question on that. I'm sort of, in my mind, I have a chicken and egg question, which is, I can imagine a workflow where the leadership of the SEC has something in mind to begin with, and they look to academic work to see whether, let's say, the academic work is consistent with the policies that they were already kind of thinking of. And another way is more, let's put it, start at a blank slate, and you kind of like look to see what the academics are saying as a way of sort of determining where your policy position comes out. I imagine a lot of academics would like to see that it's the latter, but in practice, how does it actually work? Do the policymakers kind of come in with certain directions that they're already kind of interested in, and then just sort of look to the academic work to see whether that's consistent or to draw deeper insights, or is it more of a blank slate approach?
Right. I would say it's probably not a blank slate approach, but then you do have to ask, where do these intuitions come from? So there's the famous Keynes quote about people think they have their own intuitions, but it's some long dead economist. So I do tend to think that these intuitions trace back to economics in some way or another, though it's often a rather slow and indirect process. But you're right. It's not like somebody will take an academic paper and say, "All right, we got to do this now." People will come in with their own views. Now, there is a issue though, which is that the SEC economists and the staff in general really does have to take a hard look at the economic consequences of a rule, and that's not just because, as the saying goes, economics always wins. I've just heard that saying actually for the first time, but it makes sense. The point is that market participants are going to do what they want to do, and they're going to, if a rule is just not feasible from an economic perspective, people are going to try and get around it in all kinds of ways. So you wanted a reasonable outcome in line with what you think is going to happen. So that alone is a reason to try and look at the literature in an unbiased way. However, there's also litigation. So if the rule is going to push people in a way that they don't want to be pushed, they will sue. And then if the SEC has not looked at the research in an unbiased way, in a way that's come out as part of the notice of comment process, the rule can be vacated for being arbitrary and capricious. And there's court precedent for that. So it's really actually quite a remarkable story of how economics can be influential. It's actually, I will say, unique to the SEC at this time in terms of how economics finds its way into SEC rulemakings. To that specifically, we have an agency whose rules have been vacated because of its failure to discuss the economic literature appropriately. And so that is very much in everybody's mind, even though that last happened over a decade ago. And what that means is that it's going to be a fulsome discussion, even parts of the literature that don't agree with a favored position at the time.
Yep. So now, turning the conversation a little bit towards crypto, I would like to compare what happened when you were in charge of the office, leading the Chief Economist office at SEC, with what we have today. So during your tenure, crypto assets were really front and center. In the center were a lot of enforcement action. So the focus was more on somewhat constraining the space of possible activities or strategies or securities that were related to crypto markets, including the OA test to test digital assets. And then there have been, I was wondering what were the most important crypto policy questions back then that were deliberated at the SEC, and whether or not the emerging crypto economics literature, because that was the time where also many groups or academic groups, including the CBR, which is now one of the most established groups in crypto economics research, were being formed. Did you actually pay attention to any of the studies that were being done, and was there any of the insight that came out of this research useful for deliberations?
So I think that so there's a lot in your question. So yeah. I'm going to kind of take it from the top and
can decompose it in pieces.
Talk about the what I think seem to be differences, and the differences seem pretty salient to everybody. Yeah. Which is the withdrawal of the number of of enforcement actions, and many fewer enforcement actions, as well as more what seems to be a sort of more open attitude towards exceptions, and we see that with various statements. So I think that in some ways, though, what has remained the same is that there's this core set of problems, and those problems need to be solved somehow. At least that's how I see it. And as far as I can tell, that core set of problems is still there. And so, perhaps you could say that, while I was there was one approach, and maybe that approach represented a sort of wishful thinking, which is that not to put, just giving my perspective, you might say that some of it was, well, if the crypto industry cannot comply with the rules, then maybe the crypto industry should not even be there. Or maybe they really can comply with the rules. They're just not trying hard enough, versus, well, we know they can't comply with the rules. So we will engage in rulemaking slowly. And in the meantime, we'll have a somewhat ambiguous attitude. Because I think what people miss is that the rules are pretty tightly constraining, and they are about securities as a whole. Now, that's not going to affect the entire crypto ecosphere by any means, because some of the most widely traded tokens are now been agreed to not be securities, but many are. And then many of these things are traded together. And so there's definitely going to be an impact. And that impact is not going to depend on the politics of the moment. It's still there. The question is, how do you deal with that, and on what timeline? That's what I see as more of an issue. So I think that those issues are still challenging. And I think one thing that I hope that your listeners should keep in mind is that the current rules really evolved with our current market structure. So stock and bond trading, option trading, all of this evolved as along with the SEC. So, for example, the New York Stock Exchange, of course, predated the Securities and Exchange Commission. It was its own, in the normal English usage of the term, self-regulatory organization. It set rules for its members. Similarly for FINRA and NASDAQ. And the SEC essentially kind of took these rules on in a way. It created this official self-regulatory organization regime. A lot of the ways that stocks and bonds are traded, while regulated, evolved in the way that they were actually traded. We didn't see this with crypto. And so therein lies the challenge, along with the fact that it's very hard to get away from the fact that many tokens are securities. And so that invokes the securities laws. It's just there as a kind of fact of the universe. So if you were to basically say, well, they're not securities, you're going away from what is established precedent, which seems like something that people don't really want to do, and there's not necessarily a good reason to do it.
Right. So you mentioned that at least some crypto assets are now, I suppose the common view is that they're not securities. And so I think then, if I understood correctly, when you were talking about the rules that were not being followed, you're referring not to those assets, but rather to assets that, as you said, are securities and weren't following securities laws. Could you maybe make that a little bit more concrete in the sense of, to make it sort of more concrete on the other side, I think most people at this point tend to not think of, say, Bitcoin or, say, Ether as securities. But then when you're talking about the space of crypto assets that are securities, could you clarify sort of maybe a prominent example of that? And could you also maybe provide a little bit of context on specifically sort of what aspect of securities law was being ignored?
Absolutely. So I'd rather not name any tokens that specifically. That's probably unwise, and I don't want to make a mistake and get anybody into trouble. But specifically, what is being ignored? So if you're facilitating a trade for somebody else, that generally makes you a broker, or if you're trading with a customer, that generally makes you a dealer. And so potentially, if you're an entity that's facilitating trade, somewhere in that entity, there's going to be a broker-dealer registration. And that is the case if that entity touches a token that is a security, or potentially, some would say potentially a security. But the point is, if you've got some securities in your mix and you're facilitating that trade, then you're a broker-dealer, and that requires registration. And so that's one way. If you are a platform on which this takes place, then you are subject to exchange registration or the exemption under the alternative trading system. So all of these economic activities, which seem, so easily done under crypto, people are not registered. By the way, it becomes very difficult. This is I think you referenced the chicken and egg problem, because if the tokens themselves should be registered offerings, if they're not, then they can't be traded by compliant entities. So what happens if you've got a lot of things that are not registered, you've got entities that are not compliant? how do you then take this and then bring it into compliance, especially if the compliance means something that is actually hard to do. It's a structure that was not created for crypto, but nonetheless applies. So does that answer your question? I think this was part of the idea that with stocks and bonds, we don't see this. I mean, it's all there, but it's disappeared into the background because the ecosystem has developed together with the rules. So it seems perfectly natural that we would go through a broker when we trade stocks, and that broker would go on to a registered exchange. And that when we trade bonds, we might call up the bond dealer who will then, also go onto a trading, an ATS, a trading platform. So, or contact another broker. All of this is very easily done. All of the clearing takes place in a way that everybody's used to. But this is how a compliant system works. And with crypto, it's a non-compliant system. If it were compliant, it would work the same way. There would be registered exchanges, there would be registered broker-dealers, and the assets themselves would be registered offerings with the SEC.
Right. But so there's a certain context, as you were talking, that I was thinking of, in the context of centralized exchanges, where I think everything you're saying kind of very much rings true, at least in my mind. I'm curious, though, when we talk about transfers of some of these assets, which, let's say for the sake of argument that we're talking about a crypto asset that we stipulate as a security, and we're talking about it in the context of where the transfers are being facilitated by smart contracts. Now, these smart contracts may be part of an application that takes the namesake associated with sort of entities in the real world, but a lot of time, people in the crypto community sort of say, look, there are ways, essentially through things like decentralized exchanges, that we are doing swaps with essentially computer code. It literally is sort of a call to a function. You can ask, how did the function first how did the smart contract get deployed and so on? But usually they'll kind of say, look, there's not really, there's not an entity there, and there isn't agency just by construction of it being a smart contract and so on. Not that there wasn't at some point in time when it was written. And so I'm curious to hear your view on kind of how regulation or how compliance with securities laws work in the context of essentially doing a transfer through a smart contract.
Right. So I think that in principle, somewhere in there is a entity that would need to register. And maybe it's a little bit hard to pinpoint exactly where it is. I would say that, Fahad, that's the hardest case in my mind. Because it's how this thing is decentralized by its nature. The idea of registration is a centralized concept. And so in some sense, it kind of takes away the point to say, well, the people of this contract need to get together and register. Now, there is, I'm sure you're familiar with the, probably going to mispronounce it, but the Uki Dao case, that was a CFTC case. But the point is that the judge in that case, in one of the steps, decided that the participants of that DAO had been legally served with the papers. And the fact that it was a decentralized entity did not mean that you couldn't legally serve it with something. So I think that has meant that some people have said that this is a plausible concept that you could apply rules to fully decentralized entities. All of that being said, I'm not saying it's easy, and I'm also not saying that I have I am saying that I don't know how to do it. I'm not saying that I know how to do it. And so, one thing you could do is and I'm not making a specific recommendation to the SEC. There's a lot of issues here. But for hard cases, often in the past, the SEC has given time-bound exemptive relief. I think what makes it tricky in the decentralized case is that there's a lot of things that run around and call themselves decentralized but aren't. And so if you create a structure where the dividing line is it decentralized, you've then created an incentive for a lot of things to appear decentralized. And then you're putting a big burden on the SEC staff to try and decide, is it decentralized or not? So on some level, I actually like the idea of sort of a temporary carve out while we all figure out what's going on. And I think that the reason why this hasn't taken off is not because it's not in principle a good idea and people reject it. It's that how do you create that temporary carve out from swallowing the whole ecosystem?
But so maybe just to continue on this point, can I ask, can you envision a situation where the trading mechanism on chain actually doesn't have somebody who you think the law would say you can serve? So just as you were saying, as you were talking about, I was thinking about the idea that, look, the most prominent decentralized exchange does have sort of a DAO structure attached to it, but at the same time, that's not actually necessary at all for the functioning of that exchange. The idea that I take the source code associated with, say, a constant product automated market maker and deploy it, or somebody else does, and then just walks away and has no interaction with it, is actually, first of all, it is literally feasible, and the sort of the economics that sustain these existing liquidity pools and so on actually don't really have anything to do with the token that takes the namesake of it. And by the way, one thing I was thinking about as you were talking about that is that in some sense there's like I think the crypto community has almost sort of been pushing back at, let's say, regulators and so on, saying like, you aren't telling us where the lines in the sand are in a clear way from our perspective. So we're sort of, reaching around in the dark. I'm not saying that's actually true, but it's certainly a critique that I'm sure you've heard. And so, for instance, if it was clear that, look, there is a structure that we agree does not fit within this framework, maybe because there is, in this case, literally nobody to serve, and that means that if there is going to be some apparatus around it, that Congress needs to figure that out. But currently, there isn't an apparatus that's relevant to it. That may actually cause the incentive structure where, for instance, it becomes more incentive compatible to develop something like that where there isn't actually, the burden of regulation, and there is the opportunity to have a real conversation about like, okay, so what are the welfare effects of this? And let's decide on the regulation in the context of the welfare effects, because the truth of the matter is we don't really have a regulatory architecture to deal with the case where you are literally just interacting with a smart contract and the developers are even gone. There's no DAO attached to it. All of that is actually sort of, practically, literally possible. And the question, I suppose, then there's this question about, well, actually, let me bring it back to sort of the question I started with is, so do you agree that at least there is conceptually a situation where there wouldn't be anybody to serve?
So I think that is a great question, and I'm actually going to maybe disappoint you by not answering it, in part because I don't know if I have the right expertise, but I think that is the right approach, in that maybe the way to think about this is to establish the edge case. So is there really an edge case here where you can say this thing is out in the wild and it's not, it's just not going to be subject, at least temporarily, in a time-bound way, to regulation? Now, I think that there are still going to be issues. So that thing is still going to connect to the real world. For instance, some entities that are actually registered might be very active on it. You might want, for example, when the smart contract is being initiated, that's a market structure decision. And our previous securities laws prior to crypto has at least taken the view that that's something where the SEC should take a look at. So, stock exchanges, if they're going to have a new policy, they will have to run that by the SEC through what's called a 16B process. I say all of that to mean that if you're going to say that there is this entity, and there's one thing about the entities that are already kind of out there in the wild, there's another question about, let's say somebody writes some new code for a new automated market maker. Is that something that, is it inevitable that we're going to get to a place where that thing does not have any scrutiny? What are the consequences of that? Maybe that is something that we can accept from a cost benefit point of view, actually. Maybe that's where this is necessarily going. But I think that you can see that some people would have a question about that. And part of that question would be differentiating between things that are already out there versus the things that have not yet been written, but are going to be written. But I do like your approach a lot in terms of, let's think about the edge cases. Those should, in some sense, the ones that are hardest to regulate should be the easiest one, and see if we could draw a tight circle there. I say that while nonetheless thinking that the industry's practice of wanting bright lines is a little disingenuous, because you kind of then you find this bunching around the lines. You have to be very careful if you set that bright line that the bunching around the lines is what you actually do want at the end of the day.
Yeah. And I was wondering, like, what are your views on avoiding any regulations altogether, in the sense that when we thought about blockchain or decentralization, the overall idea was to create a system which doesn't need to be regulated, right? By definition. Is there, and then of course, like, there is a disconnect between what are the premises and what is the actual implementation. Do you view, has there been any discussion about, let's say, try to make sure that, for example, the code or any programmable finance system is by design compliant, or like or like maybe having other automated systems such as smart contracts which take care of regulating in a decentralized manner the rest of the system?
So I'm reading your question to say, first of all, is there some benefit in having a system that is just standing outside of regulation by its nature? And then maybe there's a way that system can be regulated in a means that's sort of native to it.
Yes.
Is that kind of is that what you're asking? And
yes.
I think that's very interesting, because I think in principle, and I know there's interesting work being done on this. Smart contracts could make regulation much more efficient, because they could, for example, make it clear that you have to stay within certain margin requirements. It could mean that you could commit in certain ways that you can't commit when you don't have a smart contract. There's certain transparency that comes with it that is not there in the current system. So my view is that there are a lot of interesting possibilities here. We don't know. It's impossible to know how big they'll get. But I think that the SEC has often been very good about the idea that about encouraging innovation in a setting where you don't know if something is going to be big. And so to some extent, over the years, I know that the current administration is more into encouraging that innovation. But I do think that it was a little bit of a more rocky start here with crypto, and that probably has some things to do about both sides. But in principle, this could happen. And I am sympathetic with this idea that, you want something that is not state-centric. Now, that there's always going to be some tension there, because the state's going to want its, know your customer and anti-money laundering. And it's going to be kind of annoyed if you have a cash system that's not there. And then there's maybe some benefit to having the Federal Reserve be the currency, determine the currency. So I think that there is always going to be that system. But from my point of view, having a competitor currency is no bad thing.
So I just want to sort of separate, I think, two concepts that we've been talking about, which is that on the one hand, I think, and so correct me if I'm misunderstanding, but on the one hand, we're talking about the fact that there is an existing legal framework that applies to certain things happening in the crypto ecosystem, and in some sense, the welfare implications of what is happening in the crypto ecosystem is not at least as relevant in that context, because when we have laws on the books, those laws are supposed to be enforced. Maybe they're bad laws, then Congress should pass another law saying that law is gone, right? But the laws that are on the books are on the books, and when they're applicable, we generally, I think, say that they should be enforced. There are agencies that can choose not to enforce, but I would say in some sense that there's a piece there where we're saying when the actions that players in the crypto ecosystem are taking are within the purview of existing law, they should follow those laws, and that seems to be part of of what you were talking about in terms of what the prior SEC administration was doing. But then there's a second piece, which is if I should say there is a part of what's happening in the crypto ecosystem that doesn't actually fit under existing legal frameworks, then there's a question about what the legal framework around that should be. And some people will say there shouldn't be one, but that's But that's just one view. But my point, so I guess, is then that if you agree that there is the theory, there's a possibility, which I think you're describing as an edge case, that there might be aspects in the crypto ecosystem that don't fit under current existing legal frameworks, then it seems to me the welfare conversation becomes first order, because the question is, what is the legal framework that should be there? And I would imagine that welfare is very important to thinking about, establishing, let's say, new legal frameworks. And so with this long wind up, I want to ask you a question on this, which is that what is the sort of welfare calculation as far as the regulators and policymakers are making? So let's live in that, what you're calling an edge case. Now, now let's talk as economists. What is the objective function? And you mentioned KYC AML. So is that like the first order thing that we just want to make sure that certain players can't touch these assets? And is that like a totally binary thing? Because I don't see how you make with 100% surety that a particular actor will not be able to touch anything, actually. There's also investor protection, which I don't think we've talked about yet. But could you kind of clarify that for what you're describing as the edge case, for what some of us think of as maybe a bigger case, what is the objective function that matters here? What is the objective function of policymakers and regulators?
And I think that, so first of all, you're exactly right. This is where at least a form of welfare analysis comes into play, because what you're describing, so just the stages. What you're describing in principle is a rulemaking exercise that the SEC might do, perhaps jointly with the CFTC. And the rulemaking, then that invokes the economics. Now, before you get into rulemaking, you do tend to sometimes see things like no action relief or exemptions that are temporary. And so that's why I kind of put that first. And then you don't often have, or you don't have those are not final actions. They're generally not viewed as reviewable by courts. You don't have a formal economic analysis that goes with them. Though I think it actually would be useful to have economists start to think about those things in a formal way. All of that is to say that once you are interpreting the statute, you're essentially then carving things up one way or another. You're defining edge cases, as you will. That is when an economic analysis comes in, and then you're asking the question, well, what is that economic analysis? What's within scope? How do you do the calculation? And that is a very deep question that is unresolved. Ultimately, it's sort of a work in progress, I would say. So first of all, I know I mentioned AIML, like that is not necessarily in scope. So what you would probably think about is the effective, you don't generally think about society as a whole, though you could mention it, but you're really thinking a little more narrowly at the affected parties. And so in this case, it would be the people who are engaging most directly with the platform, and you would then be somewhat trading off. But the usual trade-offs that come in are about competition versus investor protection. And then you think about what are the downstream consequences of having drawn the lines the way you will. So there isn't at the moment, and I personally think such a calculation is probably beyond the bounds of human knowledge, perhaps ever, but there isn't a explicit welfare calculation. That's pretty hard to do with financial regulation. What there is there might be a cost number. Well, people will attempt to produce a direct cost number. I personally found that pretty useful. Like, how much do we think in hours direct compliance is going to cost people? Then there's some indirect costs if people have to give up information, for instance, that's often a larger that people are much more concerned about that than paying the cost of compliance. Maybe certain entities are going to have more trouble than others, and so it will affect competition. So I think an analysis, and this is often very carefully done, entity by entity, how this rulemaking is going to affect things would be applied. And so, for example, in this case where just speaking purely hypothetically, you might say, well, these truly smart contracts out in the wild, these are not brokers. I'm not a lawyer. I'm not saying this is what we should do, but or what is currently there. But let's just say hypothetically you were going to carve something out like that. You would say, well, that would then put them at a competitive advantage potentially with other entities that are close to the line. Does that competitive advantage do something they might grow as a result of that competitive advantage. Now, what are you going to do about the fact that there are retail traders, retail investors from the SEC was there to protect engaging with these platforms? Do they have the right set of expectations, given that most of what they engage with is a regulated system? One of the rules that we see about exchanges is that you want to protect the integrity of the data. What do you do about the integrity of the data? Can you have manipulation? Watch trading is one example of many. Could you have entities on this platform, for example, manipulating the data for their own benefit? Could there be self-dealing that's harder to detect? These are just examples of things that you might want to look at. So it's not at the end of the day one number. It's more like, what are the direct costs? And then here is the set of plausible economic effects we could see. I think that's actually extremely useful to put into writing. Oh, and by the way, along with all of that is a statement about why we're doing that. Because while you and your audience may think that it's a great idea to have these smart contracts out in the wild, not everybody agrees. So there would be a statement about why we think this is important to let this happen, despite the costs. And I think actually putting all that in writing, putting it out for notice and comment is extremely powerful and adds to the sum of human knowledge in a way that in itself is a good thing. So that's how it would proceed in a rough way. So hopefully that answers your question.
Turning live to the current times, like after your departure, there has been a lot of change in the SEC under the new chair, Paul Hawkins. And we have seen also the FCC has dropped numerous enforcement actions in line with the current administration, which is like launching more like crypto initiatives, like they launched the Project Crypto, they passed the Genius Act, also the Clarity Act currently under discussion, I think, in the Senate. How do you view this transition from, let's say, a regime which was very much based on enforcement and limited in crypto innovation to a new regime which seems to be more rule-based and crypto supportive? Do you think this new approach is right, or do you see any risks or anything we should be careful and maybe cautious?
Well, I think that it's definitely a more crypto-friendly approach. Yeah. I think that that's something that is absolutely fair to say. What I continue to look for is the solving of the hard problems, because it's one thing to pull back on enforcement, but for what people really need, if they're going to invest in a serious way in something, is kind of more long-run progress on whether a approach is going to pay off. So I still think that's, out there are hard questions that pertain to this. Some of this is going to be the CFT, some of this is going to be the SEC. And that's a partnership that can work, but it doesn't always work. Historically, there's been jurisdictional issues from the very beginning, and that is just kind of the nature of the beast here. So it's hard for me to see a world, unless quite a bit is given over to the SEC. Now, I'm an SEC person, so I'm going to say, look, that's not a bad outcome. Unless quite a bit is given over to the SEC, I don't see a world in which these agencies are not going to be kind of in lockstep, because you're going to have entities. So not everything is going to be out in there in a while. There's going to be regulated entities that are engaged in securities and non-securities transactions linked together. So something's going to need to be decided about how that's going to work. There's a bit of I'm going to call it an awkwardness, but the CFTC is historically, it's a derivatives regulator. It's not an underlying regulator. And it's become an underlying regulator in some sense, a little bit by accident. And so there needs to be some decision about what to do about that, because if it's really, you don't typically have retail investors directly trading in like pork bellies, but you do have them trading in Bitcoin. And so are you going to restructure the CFTC to deal with that reality, for instance? Maybe some of this stuff should actually be under SEC jurisdiction. That doesn't seem to be contemplated, but I actually think in some ways that would be the least disruptive change. because then at least you've got a single regulator, not two regulators, say, who both have to agree on, say, what an exchange looks like.
So, if I may ask, you've talked about sort of costs and benefits a few times now, right? One thing that we haven't talked about, though, is on the benefit side. A lot of times, I think people in the crypto community see part of the value in envision part of the value in having these mechanisms on chain is, for instance, enhanced liquidity in particularly, for instance, relatively tail assets and so on, right? And that, of course, interfaces very directly with the sort of regulatory scrutiny part, right? And what I'm talking about here is, as economists, we can conceptualize this as a two-sided platform, and by which I mean, look, the liquidity providers, the investors, are paid through trading fees. There's no trading, there's no incentive to provide liquidity, right? And if nobody's providing liquidity, the trading costs are insane, and nobody wants to trade, right? So we have a very sort of classical economic result about the trivial equilibrium arising when, basically, if you cut off access, you can basically generate a situation where, by construction, it's useless because you basically get, the trivial equilibrium that we see all the time in the sort of platform literature in economics. But that doesn't preclude that there's not a high adoption equilibrium that has very, very low trading costs, right, and very high investment, right? And at least, you sort of alluded to the crypto side of the debate as it sounded like you were saying there's a normative view that this is good, but actually I'm not really sure that's fair of at least, say my position on this, right? It's more, are these mechanisms potentially useful? But then, it seems to me that we have to have a serious conversation about, well, can the liquidity benefits for certain assets, for instance, be advantageous and to particular clienteles? And I don't hear a lot of that, frankly, when I listen to the sort of what regulators are saying. One thing I do hear a lot, by the way, on the cost side, we've sort of talked about investor protection a few times now, is things like maximum extractable value, which if you look quantitatively at maximum extractable value, the numbers aren't very large and they're getting smaller. And so I guess part of what I'm wondering is this conversation in the policy, in the regulatory community, in the right place? Because if I'm being blunt about it, every time I hear regulators talking about MEV, it sounds like they're talking about a ghost. And as with these sorts of phenomenon, when you actually go out and explore it, it turns out it's not a ghost. It's a little rat that's a nuisance, but it's not actually going to, kill you in the middle of the night or something like that. And on the flip side, we don't have very much conversations outside of academia about the potential liquidity benefits. And I think it's completely reasonable to say, look, we have a great scholarly analysis here that shows that these mechanisms are not really adding anything to any assets and to any clientele, and so we shouldn't put any exemptions there, and we should, be as strict as possible, because the only thing that could happen is the investor protection issues that come from MEV and so on. But it doesn't seem like that's where the conversation is. I haven't seen anything bordering on a serious argument against these mechanisms, and I haven't seen very serious engagement with all of the work being done by people like Agostino to study the sort of welfare implications of these mechanisms. So could you just maybe talk a little bit about, this kind of goes back to earlier, we were talking about the academic literature and the extent to which this filters in. It seems to me a lot of the academic literature that has been written is very first order to exactly what we've been talking about, but it doesn't seem like it enters the conversation.
Yeah, well, that can be frustrating. And I think that at the SEC, there's going to be a lot of things going on at any given time, and a lot of the decision makers are not necessarily economists. So that's the reality. And then and this is something that, frankly, I also saw, and that it can be very frustrating as an economist, where you can say, look, this thing works. Why can't we do X, Y, Z? Well, maybe X, Y, Z is harder than it seems. I think that there's a couple of points to be made. First of all, economists could sometimes do a better job of writing for non-economists. So that's one thing to keep in mind. Another thing to keep in mind is this concept of, when the train is moving, kind of hook onto it. So I think that if rulemaking ever does get moving, which I actually sincerely hope it will, this is the time to point out that there's this like vast set of benefits that potentially are missed. And by the way, I didn't mean to say that people are pro crypto for no reason. I also see that potentially there are problems that crypto could fix, like real actual problems that blockchain technology could fix. And that's why what I like about the idea of experimenting with it. So one of these might be liquidity, and that's going to have certain benefits. Now, here's where I think one has to be a little bit careful. So if the SEC is doing a rulemaking, it's got to be upfront about the why. So I'm going to give an analogy, which will hopefully be helpful to the future time where I could envision a rulemaking and you, Fahad, and Agostino write in a comment letter about how great the rule is and how your paper shows it's really great. So you might remember that there was a climate rulemaking. So now some people had the view that the climate rulemaking was going to help the environment, but we at the SEC could not help the environment. We were not an environmental protection agency or the environmental protection agency or anything like that. So for people to write in and say, great rulemaking, you're really going to help us stick it to large corporations and help the environment, not helpful. I'm not saying people did that. I'm just saying as a kind of example. So if a mechanism is going to help people, it should be investors, and it should be somewhat narrowly targeted to the purpose of the rule, if that makes sense. So I think that one of the questions that I find fascinating is how things like price transparency could help broadly with economic growth. And I think the way that kind of comes out in SEC speak is that it helps with capital formation. So you can talk about how liquidity leads to better prices, leads to more trading, helps with capital formation. I might phrase it that way, as opposed to say it helps make all of us better off, because making all of us better off, not really the SEC's job. So that would be my practical advice. And I think that these things they kind of, and it's the same with any kind of scholarship, and the poor assistant professor who's trying to like publish in the journals. It's like nothing breaks through, and then it does break through. And so once the train starts moving, I would say just get ready to hitch the cars on, in terms of how you guys think about it, and then just be aware that you're writing to non-economists and think in terms of capital formation. This would be my advice.
Yeah, thank you. I think at this point I would like to wrap up and conclude this great episode where we have hosted Jessica Wachter, and I would like to thank Jessica for sharing a lot of very good insights and having a very interesting conversation with me and my co-host Fahad Saleh. Thank you again.
Thank you.